Hello and welcome. Global interest rates are still at multi-year highs. So what's the outlook for the bond market? And what's causing investors to take interest in the Indian debt market in particular? To answer this and a lot more, we have with us today Tanveer Sethi, Investment Manager, Fixed Income Strategies, Kotak Mahindra Asset Management, Singapore. Tanveer, thank you so much for joining us today. US yields are back above the 4% mark. So what factors are propelling this?
Hi. So the US yields have been quite volatile, and there are a host of factors that are playing into it. If we rewind a little bit, what happened a few years ago, we went into COVID. Post-COVID, we had supply side constraints, and then there was, due to lockdowns, there were increasing household savings. And so from both supply side and demand led, we saw a rapid increase in inflation in the US. And we saw an increase in inflation globally as well. And since then, the Fed, of course, hiked rates very aggressively. It took the rates to 5/4, 5/2. And as a result, the inflation has been easing. First, if you look at the global inflation, if you just look at what the numbers the IMF has printed, the global inflation has come down significantly from around 7% in 2022 to roughly 4.6% in 2023. And that is now projected to be 2.6% for coming year. So clearly inflation is coming off globally. Likewise, the US inflation too has come down. If you look at the core PCE index, which is the preferred gauge for Fed, that number was hovering around 5.5% to 6% a year or 2 years ago. That has now come down drastically. If you look at the last two prints, that was under 0.2% on a month-on-month basis. And if you look at the 6-month rolling average, that was also at under 0.2%. So that has been quite what one would say is that markets read into this lower inflation as something which probably would lead to a fast increase in rate reduction cycle by the Fed. But then, the story has not ended there. What has happened is that the other macro data has come out the other side. First, we had the GDP number that came in at 3.3% quarter on quarter. Now, for a US economy, that's quite strong. For an economy that has largely grown around the 3% mark for a long decade, when the interest rates are so high, you expect it to be much lower. So that surprised the market. The market's anticipation was around 2%. So that led to the initial increase in rates that we saw in the US market. Subsequently, the Fed came and clarified that GDP growth is not a problem. They said we are going to look at the labor data. And in a sense, the market got that let's ignore GDP. If labor data from here eases, we will find rate cuts could be faster than where they are. So again, the rates rallied. And after that, we have seen the NFP numbers. They've come up out to be significantly stronger. We have seen the unemployment data continues to be strong, hovering around the 3.7% mark. And the latest, we have seen the CPI inflation shoot up. While the core PCE inflation is not yet out, the market interpretation is that this could be as high as 40 to 45 basis points for the month, which translates into a much higher number. So the yields are shooting up back once again.
Globally, you are seeing central banks keeping liquidity quite tight. So do you think that this is going to be the condition going forward as well?
So I like this question when people say that liquidity is tight. See, from global perspective, it is unwinding of the excess liquidity that was created during COVID. So if you look at the Fed's balance sheet, the SOMA holdings that they have, that was roughly US dollar $3.5 trillion pre-COVID. Now that number shot significantly higher to around $8.5 trillion at its peak. Now the Fed is normalizing that. Where are we presently? We are at roughly $7 trillion. We are still 2x of where they had started. So I think they will continue. They will continue for some time. I don't think they're going back to $3.5 or $4 trillion kind of holdings. They probably will stop around $6 trillion, and my expectation would be by the mid or end of 2025.
Of late, we've been seeing a lot of interest in Indian bonds, but this even as the FIIs continue to sell the Indian equity. So, what do you think is the reason for this?
The reason is obvious. One, of course, is the rate story, where the rate story looks much better. The currency has been reasonably stable. Inflation is under control. The current account deficit is running relatively low. But the bigger factor is that India has been included in the global EM indices. So with that, we expect the estimate is roughly $30 billion of benchmarking of global investors into Indian fixed income. So that we have seen roughly what I would say roughly $4 billion in the last quarter of 2023, and we have roughly seen another 4 that's already come in. So we have another, I would say, $20 to $22 billion that would be anticipated purely on the back of this index inclusion. And beyond that, we could find active money coming into India as people play the INR carry trade.
So it's been very interesting to note the trajectory of the Indian currency, and 2023 was perhaps one of the most stable years in a decade. So what's your reading as Indian markets actually prepare for a dovish RBI?
So, of course, the rupee has been very stable, and I'm glad that you asked this question, because I'm going to touch upon something which I believe is a fundamental change in Indian fixed income story. So to start with, of course, the current account deficit is very much under control. We are talking about a 1.1% current account deficit. I'll come back to the current account deficit in a bit. The inflation has been very much under control. We are talking about a 5.1% headline inflation, a core inflation of roughly 3.5%. And we know the band of the RBI/MPC is between 2 to 6%. So the core inflation presently, the run rate is below the middle, right, the median 4%. So there's no worries on that count. The fiscal deficit has been quite good. The central government continues to consolidate. So that is again on the positive side. So put that all in together, plus the inflows that we are seeing into now by Indian debt and previously by Indian equities, that all is helping the Indian rupee to be stable and will continue to be the case going forward. I'll just add what I mentioned about current account deficit. I think this is a very interesting point, and current account deficit is the single largest factor that is going to impact the currency, that is the running account. So if you look at the deficit, we always had a very high dependence on oil. Now that has been coming off. If you look at oil, petroleum products as a percentage of imports, they're roughly 25-26%. And if you take the net imports minus exports, the net imports are give or take roughly 13% of the imports. So it's a much smaller number. So today, India is not as impacted by oil as it was previously. Now, what is the other thing that's really picked up? We look at electronics. Electronics has gone up to 13% of imports. This is a big number. Over here, I believe there's a structural change. A is, first when you roll back, we'll see that the services exports have been good. The software segment, the outsourcing industry, that has led to the current account deficit to come off. But going forward structurally, I believe that with the two things that's happening, one, the Make in India program, and second, that as people are diversifying away from China, they're finding the +1 in their manufacturing setup, incrementally people are expected to come and set up the units in India. And we've already seen the likes of Apple announce that. As that happens, what you're going to find a two-way benefit to India. One is the exports are going to go up from India, and even if the exports don't materially change, even if the entire production is not there in India, even if it is a part, to the extent the value has been created in India, to that extent, imports are going to come down. So I think over the next few years, we potentially can move towards a current account neutral kind of a scenario 3 to 5 years from now. I think that bodes very well for the currency. I think we could find a reasonably stable currency going forward.
While that's reassuring, I have to ask, what is the biggest threat that the Indian bond market is facing right now? And will you be watching the fiscal deficit and the borrowing program in the upcoming budget closely?
Ask me none. Okay, the threats are always there. There are no obvious threats, there are none of them which are there in our base case. But of course, any threat that comes from the unknown in the US, if the US economy's direction changes significantly from where we expect it to be, and the Fed has to react in a different fashion. If you find the geopolitical risks, we have multiple conflicts that are open, whether it's the people have forgotten, but there is one, the Russian-Ukraine conflict. There has been a little conflict in the Middle East, and now we are seeing a little bit of disruption in the Red Sea. If the conflict becomes bigger than anticipated, that can of course add to the volatility, and also crude prices could significantly jump up. We discussed it's much smaller, but nonetheless it impacts the Indian rates and the currency story. The government has consolidated much more than the market anticipated. And we are looking at a fiscal deficit of 5.1% for this year, and the following year at 4.5%. And you know what the government has done is they're not, if you look at the total deficit, they're keeping it exactly at where it was for the past couple of years. As the GDP grows, as a percentage is coming off. So they are quite focused on consolidation. As a result, what we are seeing is the gross supply, the net supply more so, of the Indian government bonds, that is constant over the last 2 years. That is roughly $140 billion. And we discussed about the index inclusion, and we discussed how that is expected to be roughly $30 billion just this year, which is roughly 20% of the supply that's coming from the government. So with the supply remaining constant and finding additional demand from global investors, with interest rates coming down, rupee expected to be reasonably stable, I would expect this to bode well for the rate story over the next 12 to 24 months.
Absolutely, Tanveer. Thank you so much for that. Very, very reassuring, not just for me, but for all of our viewers who are joining us today.